beg your pardon, though we had unrecognised concentration risk in the middle market. We had arbitraging by the whole sector between the credit treatment of exposures in trading book and banking book, and that really worked by securitization, where you would take a banking book amount, securitize it, and sell the securitization to somebody else that would put it in there, that will then put it in the trading book. The net result for the industry was that they reduced the amount of capital held against that exposure. And we also discovered, amongst other things, that there was a huge amount of variability between banks for a particular exposure and how they reported. But there was a lot of discussion, and anybody that lived through it, there was years, or literally years of discussion, and various guises with Basel 2.1 and then Basel III, issued by the Basel Committee, where in 2.1 they took measures to shore up the most immediate problems of with Basel, and then with Basel III considered some other elements, such as making the capital more sensitive, increasing or changing the way that we look at market risk, looking at the counterparty risk, looking at liquidity, leverage, and taking a look at the model approaches. And so all these improvements, amongst others, including things like shadow banking, etc., it all came under the Basel III Accord, and we've been living in almost a constant state of change in the regulatory area for the last 10 years as a result of Basel. There was a last piece of the Basel Accord that wasn't presented or implemented, and that was actually released in a paper called Higher Level Summary Reforms, Basel III Summary Reforms, issued by the Bank of International Settlements in December 2017. And it's really the contents of this paper that is formed the last part of Basel III and Basel 3.1. And in there, they're looking at the standardized credit risk, looking at the changes in the IRB approach for credit risk, updating the CVA risk charge. There's a change to the operational risk charge, leverage ratio, and the output floors. And so it's that we've actually included in the 3.1. But given the recent history in the UK with Basel, or rather with Brexit, and the resultant changes, the PRA is also including and adapting much of this program to take into account its new flexibility. So we see in 3.1 some divergences from what's happening in the CRR rulebook in Europe. So I think that's a brief summary of how we got to where we are now.
Thanks very much, Selwyn. That's always good to understand the context before we kind of dive into any specific looks at this. So I think Selwyn covered all of those in summary at the end, and areas that we're going to cover. So we're going to start at credit risk, move into market risk, then have a bit of a look at op risk, and then a more general look at the output floors before briefly touching on the strong and simple, and finally on the kind of data requirements and reporting requirements that come out the back of it. So we've got a lot to cover in the next half an hour, and we're going to start at credit risk. And Sandeep, I know this is something that is near and dear to your heart. If you just give us a sort of brief summary of the changes in the credit risk side, and then we'll kind of dive into the discussion in a bit more detail.
Yeah, sure. Thanks, Charlie, and good morning and welcome to everyone. Thanks for coming in and listening to both Selwyn and me and Charlie. Just to build up on what Selwyn was saying about Basel III and the link to Basel 3.1, I think what Basel III did was to put CET1 capital on the pedestal and said that is the highest quality of capital that any bank can have, and all the buffers were kind of related towards CET1 and linked to that. Now, what Basel 3.1 does is build on that and concentrates on the denominator of that capital ratio. So its focus is on the RWA. And what PRA has said is that they were kind of concerned about the downward drift in the average risk weights that were being reported by all the banks. And sure, part of it could be that most of the banks were now having a higher proportion of less risky assets like HQLA in their portfolio, but they were concerned about the total RWA being lower and the average risk weights being lower than necessary. So what Basel 3.1 does in terms of credit risk is to apply a more risk-sensitive approach, and the emphasis from the PRA's perspective is not to apply all these risk weights mechanistically, but to have a little bit of more rationale and thought behind it. And the onus is on banks to justify the risk weights. So just coming into a little bit of detail on this is that, for example, that in Basel III, you can have counterparties according to the credit quality standards and apply the risk weight, the credit ratings, and based on the credit ratings, you can have risk weights attached to them. Under Basel 3.1, the banks will need to perform a little bit of due diligence on the counterparties and apply their own judgment on the reasonableness of the external credit ratings. And if the due diligence suggests otherwise, then increase that risk weight based on a higher CQS step than the one which is implied by the external credit rating. So to my mind, that's a big change, and that underlines the thinking behind all the changes that the PRA is making. So it's become more granular as well. Subclasses of exposures have been introduced for specialized lending, like project finance, commodity finance, covered bonds. The banks must assess exposures between investment grade and non-investment grade. Different risk weights have been applied, can be applied to that, ranging between 65% to 135% under a risk-sensitive approach. And of course, some of these would have to be agreed with the PRA beforehand. And the other big thing is on the project finance exposures. Currently, all risk-weighted 100%, now risk-weighted between 100% or 130%, depending on the operational or non-operational projects. Unrated SMEs within the corporate exposures are now being proposed to be rated 85%, so that's a good thing compared to 100% currently. They have also clarified risk weights for equity instruments, subordinated debt, increased them in most of the cases. And the other big thing in which a lot of the wholesale denominated banks will get caught out are the unconditionally cancelable commitments which are undrawn. They were now currently they are now considered riskless because they were unconditionally cancelable and assigned a risk weight of 0%. And under the new proposals, they will be risk weighted at 10% because, frankly, even though in the fine print they were said unconditionally cancelable, but in practice they were more or less evergreen. So that will increase the risk, the RWA for a lot of banks which are got big wholesale books for corporate clients. So there's high granularity in risk weights for unrated banks, residential and commercial real estate and mortgages, and also they have revised the risk weights for exposures in defaults linked to provisioning levels. So I can go on and because there's so many changes that have been happening. So I will stop here and let's just move on to other topics.
Yeah. And on that, Sandeep, before we kind of move on, just in your opinion, do you think banks are going to need to change their lending books at all, or do you think they're just going to have to hold more capital and deal with it, or do you think there's an incentive to move out of certain products and into others?
Well, I think it'll encourage a rethink in the banks about the business models, and there are like areas where, for example, equity finance and equity investments and covered bonds and project finance, where the risk weights have actually gone up. So the banks will have to figure out whether they really want to allocate capital in those businesses. But equally, there have been there have been attempts to encourage SME lending, evidence for the 85% risk weight. So the banks should be encouraged to get in there. But yes, it's a risk optimization game. So banks will definitely have to rethink their business models.
And Selwyn, in your opinion, I know you sent me a really interesting article where the Royal Institute of Chartered Surveyors comments on this exact bit of legislation coming in. And yeah, I mean, I can't think of a time where they would have done that before. So obviously it's a pretty seismic change. And what do you see as kind of like the key things on this? Or is there anything you can add to that?
It clearly is a sizable change. It's not very often that we have a body like the Royal Institute of Chartered Surveyors commenting on a banking regulatory law, but so concerned are they about the implications for valuing firms and the financing against those firms as a result of these changes. Clearly, I agree with Sandeep that the result of these changes, firms will need to reconsider their models. They will also have to make sure that they reconsider their internal controls so that they monitor things. I mean, like the lines of credit where they are not yet committed, but they can be revoked by the bank, where those did have a 0 and now they have a 10%. It means that banks now have to put the controls around that type of business in a much more stringent way. One of the things I would like to just comment then on and go back to though is about the credit ratings, and now that firms have to go along and make sure that they appraise the credit ratings they receive and they do their own due diligence on their lending. That's really wholly consistent with what happened in 2008, where there was a huge dependency, it turns out, industrial dependency on the credit rating agencies, of which most banks only use a handful or less, which represents a type of concentration risk right there, and from the first part. And secondly, if we're actually lending money in a lot of these cases, the financial institution should actually understand and know the counterparty in a way that better than many of the rating agencies. So it's incumbent on them to show that they've stood up and met that challenge, I believe.
Excellent. So basically, banks need to do their due diligence better and more often, and really understand.
We're lending other people's money. We need to be careful.
Exactly. I know that we could talk for hours about this and in some of the prep calls we have. So I'm just going to move on at this point in time because we've got a lot to cover, and onto the market risk side. And I'm going to throw over to Selwyn as it's something that's near and dear to his heart, and he can run us through it.
Yeah, I mean,
changes, and then we'll kind of go from there.
From a high-level point of view, the real news on the market risk side with 3.1 is the introduction of FRTB, both modelled and unmodelled approach. We've also got the fact that we've got simplified approaches that are defined out. So there are opportunities for firms that would not meet the threshold for market risk to opt out, and there's a finer granularity there. There are more choices, but in the main, it's quite clear that if you have a certain size and risk profile, the approach that you've got to take is pretty much decided by that, rather than that being a firm's choice. The FRTB is a radical departure from the way we calculate market risk from a regulatory perspective, in as much as that it's dependent on the sensitivities approach. This demands a great deal of coordination between your regulatory areas, your reporting areas, if different, and your risk areas. And there is a requirement when you calculate your sensitivities that the sensitivities used by the regulatory team are not sensitivities that are purposely created just for the reg reporting, but actually reflect what your senior managers use to control the business. So this if you, I'm quite sure any firm in market risk would have considered it, but it does mean that there's a lot to consider just in the way you actually build and coordinate your efforts in order to make sure the reporting is done. With regards to the model, okay, so if we go back and look at the standardized approaches, it's broken down into a sensitivity portion, a residual risk portion, and a default risk charge. And what you're basically doing is taking your positions, looking at the sensitivity of your trading book portfolio to various risk factors, and the ones that we commonly know, same for SACCR, equity, interest rate, commodity, FX, etc. And then after looking at your sensitivity of your books, you're using that sensitivity to generate a risk-weighted assets amount that you then take a percentage off for your capital charge. One of the things we ought to note is that at the moment, the current market risk, if you're not using a model approach, current market risk approach, firms can have an intuitive feel for how much a risk charge is going to cost. They know that if you take a bond of this amount, then and you have a counterparty of this credit rating, then approximately this is the amount of charge. You do not have that kind of feel for this new approach, because it's all to do with the sensitivity of the whole portfolio. So it's difficult to intuitively know what an incremental adjustment to your trading book will result in. We've also got a modeled approach, which uses an expected shortfall calculation. And there's a whole method there of firms in effect predicting what they expect the maximum variability of the P&L is for the next period, and back testing and making sure that their models are reflecting what the actual performance, and at the same time looking at factors that they weren't able to consider in their models and their non-modelable risk factor. And when we look at non-modelable risk factors, the PRA is one of the few places where in the implementation of Basel III, they've deviated slightly from the Basel approach in relation to non-modelable risk factors. But I'm sure we'll be covering something like that in future webinars.
I was going to say, I know that it's something that me and you have talked about quite a lot over the years, particularly as we know, like FRTB, it's been a long time in the making, let's put it that way.
Yes.
I think I just want to come back to one thing that you mentioned on that front, which was the having to look at the whole portfolio when looking at those risk sensitivities. And I know that was a big problem when the SACCR regulation came in. And I mean, do you see it being a similar type problem now with this introduction to market risk, or do you think firms have probably got the hang of it now and there's been enough lead in from?
No, I think that this is I think it really depends in the bank from which culture you're coming from. If you're used to doing straight reporting, or you're used to doing the old style red reporting, this is going to be an issue. You are going to lose your intuitive feel for how much something is going to impact you in terms of capital, right? And it's going to require you to have tools to run the calculations and actually see what the result is, because the incremental effect of an extra few units of risk is wholly dependent on what your portfolio that you're actually putting that risk into looks like. If you're used to running a risk area, then this idea and this way of measuring risk will be familiar to people who run risk areas. So this is not going to be something that will particularly disturb them. But the problem you have, the cultural problem you may have, is that risk have got not more than 8 or 9 years tradition of actually being able to repeat and review and audit the results they did yesterday and compare it to the day before, and all the good things that for the last 70 years people in finance and reporting have been doing. And so one has to be careful when even though from a reporting function you're using risk ideas and techniques, you don't necessarily want to take, you still want to retain a lot of your risk behavior, your reporting behaviors, especially in terms of looking at historical data, being able to compare, contrast and explain trends, etc., which typically risk doesn't do.
Okay. And Sandeep, I mean, in your experience as an ex-CFO and involved in finance office, do you think that this change in thinking in a finance department is something that's going to be easy to do, or do you think it's going to be butting up against sort of entrenched ideals of how to do this and old processes?
No, I mean, I do think that this will lead to a little bit more soul searching among the finance and risk people, and exactly agree with Selwyn that we should be looking at more analysis, and instead of just mechanistically applying the ratios and the multipliers to the market risk positions, but also how to control those risk positions, specifically in the light of the increase in interest rates, where a lot of the banks have got into difficulties, specifically the treatment of HTM portfolios versus the ASF portfolios and the trading book, and just the impact on liquidity arising from there. Now, this Basel 3.1 does not specifically address liquidity, but market risk has got an impact on both liquidity risk as well as interest rate risk, and how the banks adapt to it will be a big challenge.
Thanks very much. And I'm gonna throw it straight back to you for the operational risk side of things, as I know that that's something that you really want to talk about, and you think there's some interesting changes coming up in this.
Yeah, so under operational risk, under current practice, it was quite mechanistic and simple, and did not have any actual regard to historical operational losses. But this has now been made more complex with far more parameters to be considered. So operational risk capital charge is a function of what's called a business indicator component and an internal loss component, which is historical loss. And the business indicator component is a function of the firm size and the activity, and with the underlying assumption being that larger and more active banks have a greater potential exposure to operational risk. And the parameters have been expanded from just the income parameter, which was being considered currently, to the size of the firm, and which is evidenced by the cost base as well as the profitability from both the trading and the non-trading activities. So everything has been brought together, and then multipliers have been added in to calculate the capital charge on the operational risk side. And currently, the PRA is proposing to keep the internal loss multiplier as 1. It basically means that regardless of what the actual historical loss was, it does not impact the current calculations. But they have said that they will use the Pillar 2A methodologies to increase or decrease the add-ons, which would take into account the historical loss. So banks would still have to manage historical losses, report them, and be on the front foot to the PRA to say that if part of the historical losses have been legacy losses, which have been now underlying causes have been rectified, then those should be excluded from the Pillar 2A charge or from the internal loss multiplier. So those are the main changes, but I think the changes provide much more flexibility to the PRA through the internal loss multiplier parameter.
And I know, Selwyn, you had some interesting views on how firms could help mitigate some of this risk. So
I must say, when it comes to operational risk and the entire approach from the Basel Committee on operational risk, I'm disappointed with the framework we have at the moment. I think it would have been far more effective, and we would be and it would be far more serious if we allowed banks and we encouraged insurance companies to actually insure entities against operational risk. And if a risk is uninsurable, then what we should do is calculate the potential impact of the risk that we consider, and then force banks to reserve a percentage of that risk, and which is more or less the capital charge. The important thing about getting an insurance company involved is if an insurance company knows that in the event of an operational risk, they will actually have to pay physical money, they will absolutely ensure that a bank contractually manages that operational risk. And we will then create a market. We will then create very interested parties that it's to their benefit to make sure that the real operational risk is addressed. And we will have a fallback position where firms know that what they have to do is estimate the loss and then take a charge. And I think that would be a cleaner and actually more effective regime overall.
Yeah, it's interesting you say that, Selwyn. I have a slightly different view on that. I'm not convinced that the insurance companies have the wherewithal to actually price operational risk in banks, and bear in mind also that the fines and the regulatory penalties are not insurable in any case. But as you said, these can be set aside, and the banks can put a certain charge on it. But I don't think the PRA will take kindly to the idea that banks outsource their operational risk to the insurance companies, who will then have to have some way of pricing it, and pricing operational risk across global banks and small banks. It'll just introduce too much complexity and variability in terms of their calculations. So I don't see PRA doing that, but hey, it's an interesting idea.
But I think just to come back on that, and I think your challenge is noted and welcomed. But to come back on that, I think the fact that that insurance companies will actually have to pay out the actual physical money or damage or cost will actually mean that much of the variability will be eliminated. We're not actually subcontracting out the operational risk to the insurance company, because we're doing it under the understanding that the insurance company in return for actually taking on this risk will actually enforce contractually and legally that the management of the banks actually manage those banks. If an insurance company doesn't believe you're managing your operational risk properly and you don't meet the conditions, they will cancel your insurance policy, right? And I think that will keep the people's nose to the wheel. And
sorry, go ahead.
Sorry. And then my third point is, I believe that if you allow the insurance companies to actually enter this kind of business, they will develop the skills in order to cope with operational risk. And in terms of this kind of risk, I think they are the experts and the masters much more than banks are for this type of risk.
Yeah, no, I again think it's an interesting idea. It gives some alternatives, and in any case, things like cyber risk and other things are insurable, so there is a kind of a backup for that. I just go back to my experience in a startup bank, where we were trying to get cyber risk insurance as well as directors and other kinds of insurance. And we are a startup without any customers, so it was just under mobilization. and you're having a tough time talking to the insurance companies and asking them to quote for a startup with no historical data. And as you know, insurance companies thrive on historical data. Their first point of call for pricing the risk is, okay, what's the history behind it? So there's a variable factor behind it, but let's not belabor the point. Let's move on.
Thank you for that.
I know that we've got a lot to cover, and you guys could keep talking about this for hours. So it's for me, it's super interesting as well. It brings together two really strong fields in the UK in terms of insurance and banking, and whether there could be more interlinking between the two. I know, got lots of friends that work in insurance. New types of risk, they're always willing to at least have a go at pricing, even if they're charging you massive amounts for it. And so back to the kind of discussion on 3.1. I think the kind of final point, and I'm aware of time, and we're not going to get to everything, I'm afraid, is just on the output floors. So, Selwyn, I know this is more your area of expertise, so I'll hand over to you to do high-level changes, and then we'll go very quickly into the impact, and then.
So the background to the output floors was basically that just around the time of the financial crisis, many of the American banks had discovered that a lot of the European banks were applying model approaches, and for certain types of lending, they were able to get the amount of capital that they charged pretty much close to zero, and the Fed would not allow the US banks to have a similar approach. So the output floors were discussed, and they agreed to put them in place. The purpose of the output floor is to make sure that where firms have models or using a model approach, and that's either for credit risk or market risk, that the amount of capital charge as a result of the model calculation is no less than 72% of what you would be charged if you'd run the standardized calculation. This is really important because it means that all banks, regardless of whether you're a model bank or not a model bank, you are now required to have a full process that allows you to run your a standardized approach for all your major calculations. There are some allowances where, because the standardized approach is a fallback, there are the regulators do in some occasions allow you to take modeled inputs and then applied a standardized calculation process on some of the modeled inputs in order to calculate your standardized charge with which they compare. This is the output floor is being implemented in the UK in 3.1, and it will make sure that there's going to be a lot of work for a lot of firms to do, I think, without going into technical detail and looking at time as well.
And do you think that this will force firms to, change their business models and say, our model's worth it? They get out of certain products because, the capital charge is just going to rise if they're building and maintaining those models?
I mean, clearly, this has been an assault on the models. In a number of places, the number of models or the types of models that are available for firms is being reduced by 3.1. So some of the simpler models just aren't available for some of the risks, and so that will change things. The other thing is that with things like the FRTB and the SACCR, which are much more risk sensitive, one has to ask the question whether or not, after going through the huge effort, and these are huge efforts to put these in place and make sure they work, whether or not you want to do that and have a model, and what is the benefit of having a model over a much more sensitive standardized approach. And so all these are questions that firms need to consider, but the bottom line is that you have to have a standardized approach, and you definitely, no firm can afford to believe that because they have a model approach, investing in the standardized approach, and the expertise and infrastructure needed to run the standardized approach is not necessary.
And Sandeep, in your experience, I'm probably thinking more back to your time at Standard Chartered, where there would have been models throughout the whole organisation. Do you think that this is a good thing, that we're forcing firms to be a bit more standardised, levelling the playing field between big and small banks potentially?
No, I certainly think that having a floor is a good thing, and because it mitigates against aggressive banks trying to model everything all at once, and with more and more complex modeling. And you can see that for most of the global banks who would want to reduce their RWA to the maximum extent possible. But also, coming back to the other point about whether modeling, is it still worth it? I think a 72.5% output floor, which means 27.5% reduction in RWA, is still a big price to aim for. And the banks should, in all honesty, should be in the interest of their shareholders and shareholder returns, should be trying to optimize their risk-weighted assets and optimizing their capital in the best possible way without gaming the system. And I think the PRA is very much open and it's very much conscious of the fact that some banks do game the system. The other important point over here is that PRA has proposed to apply the output floor to all the UK headquartered groups within the scope of the CRR requirements. That means that all the UK-based subsidiaries of foreign banks are kind of excluded from this floor, provided that they are subject to the output floors as part of the group consolidation. And now that's important distinction, because I do think that if there are, for the subsidiaries of the foreign banks in the UK, the PRA would be very much alive to the consideration that they shouldn't be undercapitalized. And if their local RWA is kind of approaching the floor, and even though it may be allowed under the Basel 3.1 rules, I think they would be very, very intrusive in demanding to know why their actual RWA is, say, 70% or 65% of the standardized approach, and probably raise their concerns with the home regulator of the group as well. So I think there's a lot more intrusiveness which will happen.
And I do think, especially with the UK being an international hub for banking still, it's something that the PRA will really closely monitor, and it's something that I know that they are kind of looking at those smaller international banks in more detail now that they've kind of hit the big banks a little bit. They're kind of going in there, and I saw an interesting article that the number of Section 166s is again on the rise, particularly for reporting other areas as well. But it's definitely something that I know the PRA are really looking at strengthening their competency and doing more on. Because I'm really conscious of time, so I'm just going to move to sort of closing remarks from both Selwyn, yourself, and Sandeep. And Selwyn, if you have anything in particular that you want to kind of comment on as a takeaway for the attendees.
Sorry, was that for me first, or?
3.1. Sorry, hello?
It's not Selwyn, and then we'll come to you, Sandeep. Sorry.
Sorry, I couldn't hear you. So my closing remarks is that 3.1 is a big change. Firms really need to focus on the bits that most affect them and their business. Do not underestimate the amount of time it takes to reel and get the information and the data. And one of the most useful exercises would be to understand the data requirements and make sure that people or the processes further down the line are fully prepared to give you what you need. But even before that, there's some of these changes that do make firms need to consider their business and their business model and the cost thereof. So there's a lot of work for us all to do. And
Sandeep, yourself?
Yeah, completely agree with Selwyn. And I think the underlying theme of Basel 3.1 is from PRAs that don't just use the risk weights as they are given in the regulations, but apply your own minds, apply your own methodologies behind it, and which is evidenced by the due diligence requirements on credit ratings published by the Moody's and S&Ps of this world. But also they want the banks to strengthen the risk management and the financial analysis behind it, and to be able to demonstrate to the PRA that any approach they're taking either is too conservative or too aggressive, that should be underpinned by clear and logical and rational thinking. And that means that banks will have to invest more and more in risk management and financial analysis and be able to demonstrate to PRA what they have included in their RW calculations.
Thanks very much for both of our panelists today, and conscious of time for our attendees. I know we didn't get to any questions. I've seen there's a fair few that come in, and a couple of areas we didn't touch on, in particular strong and simple, and Selwyn kind of mentioned some of those data and reporting requirements we wanted to get to. But both of these are going to be covered in future webinars from Suede, and in fact, all the topics that we talked about today, we could do a single webinar on each one if we wanted, and please attend those, watch out for those, and thank you very much for attending, and speak to you all very soon, I'm sure.
Thank you. Thanks, Charlie. Thanks, Selwyn. Thank you to everybody who participated.
Thank you, Sudeep. Thanks, Charlie, and thanks for everybody joining. Bye-bye.
Bye.